Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you again today, and today's episode is going to be on Roth IRA Basics. Before we jump into today's episode, I have three quick announcements. Number one, I'm really excited that I just got some new podcast equipment. As many of you probably know, this is a brand new podcast launched in January of 2022, and the first couple of episodes were recorded on a laptop mic. So I now have a podcast mic, a headset, and hopefully the sound quality is quite a bit better for everybody from here on out. That's announcement number one. Announcement number two, I keep saying we here at Real Talk Personal Finance, and that is because a couple of buddies of mine who also actively work in the financial services space, they are also licensed and credentialed financial advisors that are practicing, will be joining me in the future on some episodes, and we're going to kind of collaborate on different topics. I'm also planning on having a couple of guests that are not financial advisors that I think would be good for different topics that we may have on the podcast. So definitely be on the lookout for that. Most of the episodes will probably be me discussing a particular topic like we've done so far, but just know that there will be some other content and some other individuals on the podcast. I'm really looking forward to it. I hope you guys are too, and that will be coming soon. And then the last announcement, number three, is we will do an advanced Roth IRA show coming up in the future. We're going to talk about all the crazy shit like conversions and conversion ladders and backdoor Roth IRAs and all that good stuff that's beyond the scope of today's show. So with that said, for those of you that are familiar with Roth IRAs, maybe you have one, you understand what it is, how it works, and you've had one for quite some time, please feel free to listen to this show, but just understand that you're probably going to get more value from the advanced Roth IRA episode. This show is really for anybody that is trying to learn about Roth IRAs. Maybe they don't have one, or maybe they do, but they don't fully understand it, and how does it work with other types of plans, and those sorts of things. Really, as the name of the episode says, just the basics. So we're going to go ahead and jump into the episode now and talk about Roth IRA basics, and think of this as a crash course, kind of a 101 on the Roth IRA. So here we go. First, what is a Roth IRA? And as the name basically says, a Roth IRA is a Roth individual retirement account, technically an individual retirement arrangement, but virtually everybody calls them individual retirement accounts. So that's basically what the name means as far as the acronym IRA. And essentially how it works at its core is that you would put after-tax dollars in. This is money that's pretty much just chilling in your checking account, just sitting at the bank or credit union. Those are the funds that would be contributed to this account, and if you play by a couple of different rules, which we'll talk about in a moment, you will be able to benefit from tax-free distributions, presumably in retirement. So those two rules that I just mentioned are, well, there's a lot of them actually, but we're going to talk about two, because when you get into shit like death and disability, it gets really depressing really quickly. So the two that are going to apply to most people and be of most interest are going to be the following. 5 tax years. And you're thinking, what the heck is a tax year? We'll talk about that in a moment. But you have to have the Roth IRA open for at least 5 tax years. So that's component number one. And you have to be at least age 59 and a half or older when you take the money out in terms of getting what's called a qualified distribution. We're going to talk about an exception to what I just said here in a few minutes, but those are basically the rules. So if you remember nothing else, with regard to Roth IRAs, as far as distributions, all you need to know is 5 plus 59 and a half, which means 5 tax years or more, and you have to be at least 59 and a half or older when you take a withdrawal for everything to come out tax-free. Otherwise, it gets really tricky in a jiffy, and we're not going to get into all the technical stuff here today. So those are the main rules there as far as that goes, and we're going to get into who qualifies for a Roth IRA and all that good stuff in a little bit. But first, I want to give you a couple of examples and kind of talk through what I mean when I say tax years, and that will kind of set the stage for everything else. So as far as a tax year goes, anytime you contribute money to a Roth IRA, it's as though that money was actually sitting in that Roth IRA account as of January 1st for whichever tax year you contributed to. And so let's take a quick example to kind of outline what I mean. We're here in January of 2022, but let's just pretend that it was May 1st of 2022. So fast forward a few months, depending on when you're listening to this. and you decide you want to make a Roth IRA contribution at that time. You realize that you're eligible to do so. We'll talk about all that here coming up. And so you make a contribution on May 1st of 2022. It's as though that money was actually in that account and as though that account was actually established as of January 1st of that particular tax year, which in this example is 2022. So the money goes in and the account gets created on May 1st, but the account and the money for purposes of the 5 tax year rule, or starting that 5-year clock, counts as January 1st, 2022. And so for a lot of people, if you're in your 20s, 30s, 40s, or even early 50s, this really isn't going to matter all that much because you still have to meet the second part of the rule, which is age 59 and a half or older when the money comes out. Not to start one, but when you take the money out. So it kind of is a moot point for a lot of people, but it is important to talk about because it does come up in a couple situations as far as, let's say somebody was in their late 50s, maybe you're 57, for example, and you don't have a Roth IRA, you've never heard of one, and you decide you want to get one started, the 5 tax year rule thing becomes very, very important at that time. But just continuing on with that, a similar example, but a little bit different, and you'll see why, is let's pretend we go back 1 month, and instead of May 1st of 2022, we decide we want to make a contribution on April 1st of 2022. Well, now, assuming we have not made contributions for the prior year or haven't maxed out the account for the prior year in 2021, we have a decision to make with that contribution. We can choose which tax year we want that contribution to count for. So it can be the prior year as long as it's before the tax deadline. So if you're before the tax deadline of any given year, you have the ability to make a prior year contribution. So in this example, if it's April 1st, 2022, we haven't quite hit the tax deadline in 2022, and therefore we have the ability to indicate whether we want that contribution to be a current year contribution in 2022, or if we want that to be designated as a prior year contribution in 2021. Now, I will tell you, most companies, if you don't specifically state your intentions for a contribution, they will almost always assume that you want it to be a current year contribution. So I should mention that. Now, let's say you decide, well, why wouldn't I make it a prior year contribution if I've not had this account before and I have the opportunity to start my 5-year clock that much sooner? And I also have the ability then to make another contribution, a current year contribution for this year. Why wouldn't I do that? And that's a great question. I don't see why you wouldn't, honestly. Because once that window closes, you're not going to get that window back as far as being able to put money into the account. So if you put the money in on April 1st, 2022, you might say, hey, this is a 2021, tax year 2021 contribution. And as crazy as this sounds, it's as though that account was open and that money was actually in that account since January 1st of 2021, even though you didn't open it and you didn't actually put the money in until April 1st of 2022. And I know that probably sounds crazy, but that's a cool little trick if you're ever looking for jokes at a cocktail party or something like that. Did you know you could start the 5-year clock on a Roth IRA in as little as 3 years and 8 months? You can tell I don't get out much. So anyway, that's something to keep in mind as far as that goes with the tax year thing. If you were to do that, you can choose which year you want to have that contribution designated for. And then, of course, let's say, finishing out the example, it's April 1st, 2022, you make a contribution, you designate it as a 2021 contribution. So now you've already, tax year 2021 was tax year number 1 for you, and that year's already over. And now in 2022, that will be tax year number 2. And remember, you've put this contribution in basically going on 4 months into the year. And so you finish out 2022 as tax year 2, 2023 is tax year 3, 2024 tax year 4, 2025 is tax year number 5. After December 31st of 2025, you have met the 5 tax year rule requirement. That's part 1. And as we've mentioned a couple times now, you also need to be at least 59 and a half when you take a withdrawal in order for anything and everything to come out completely tax-free. And we'll talk about that one exception here in a moment. That's kind of our first section on what is a Roth IRA and a couple of quick bullet points on that. Next, let's talk about some other benefits of Roth IRAs. So again, it is a retirement savings vehicle, which in my opinion has maximum flexibility. And so you heard me say a couple times on this particular podcast that in order to get anything and everything out, you have to meet those two rules, one of which is you have to be at least age 59 and a half, and that is all correct. However, the one exception that I alluded to is with regard to your contributions. And for anyone that's listened to my podcast on emergency funds that is titled, What Level is Your Emergency Fund? If you want to check that out, if you haven't, we go through a detailed explanation, and we actually have some examples and a little bit of strategy on multiple uses for Roth IRAs in the context of your contribution. So a contribution is money that you actually put into the account, the money that's in your bank account currently that you decide to contribute to this Roth IRA. That is your contribution. The other components, there's a couple of them for the geeks out there. Feel free to check out that advanced episode that's coming up because we're not going to talk about conversions right now. But the other major component other than contributions is earnings. So any dividends, any interest, any growth, capital gains, whatnot, that's all considered earnings. And that is the portion that you cannot touch prior to meeting the 5 tax year and 59 and a half rule. Refer to the other episode on what level is your emergency fund if you want a more detailed discussion on that. But that is the one exception, is that you always have access to your contributions and only your contributions with a Roth IRA, and only a Roth IRA, tax and penalty free, at any time, at any age, for any reason. It's the only account that you can do that with. Definitely something worth mentioning. We talked a little bit about, briefly in the intro here, that another major benefit is that you get tax-free growth as well as tax-free distributions. So you're never going to get a tax bill in any given year for money that's in the account as the money is growing. And that's really the power of this. There's a lot of different considerations that we'll continue to go through, but you're not going to put the money in today and take the money out tomorrow and say, well, that's great. You know, I put after-tax money in and I took out money 2 days later and it was tax-free, whoop-de-doo. The idea, obviously, is that you would have that money invested for years, possibly even decades, and the real magic is letting and giving that money an opportunity to compound for you very nicely and build up that account. So you're front-loading the taxes. You've already paid taxes on the money, but the trade-off is any and all the growth is going to come out completely tax-free on the back end. So that's really nice. There are multiple planning considerations. The ability to control income in retirement is extremely important, especially the way things are structured now. And for those of you that kind of want some little mini homework assignment for anyone that might be approaching retirement, you check out, there's actually an article that came out pretty recently by Dr. Wade Pfau on what's called the Social Security Tax Torpedo. And it's something that's been around forever. He just happened to write about it recently. I'm sure you could find some other pieces that were written before that. And essentially, it has to do with how much, if any, of your Social Security retirement benefits are subject to taxation. And getting into too much detail on that's beyond the scope of today. But just know that there are certain types of retirement plans out there when if you take money out of those accounts, that distribution is going to count in that formula that determines how much, if any, of your Social Security retirement benefits are taxable. And so with a Roth IRA, and the reason that I bring this up is that any distributions taken from certain types of accounts, including a Roth IRA, are not counted in that formula. So you could essentially take out an unlimited amount of money from a Roth IRA and not have to worry about that triggering any additional taxes for you with regard to your Social Security retirement benefit. Similar thing is true for Medicare premium surcharges. And again, that's beyond the scope of today's show, but just know that having a Roth IRA is powerful for many reasons, and sometimes reasons that you wouldn't even think of unless you're just in this space and you know basically how this stuff works. The other thing that's kind of nice, doing a little bit of a comparison with some of the other accounts out there, is that you as the account owner of a Roth IRA are never subject to what's called required minimum distributions, or RMDs. RMDs essentially is a way for the IRS to get their tax money, mostly from pre-tax accounts. There's some exceptions. When you turn a certain age, you have to begin taking distributions from most types of retirement plans. Well, the Roth IRA is an exception to that. But it used to be 70 and a half for those that are curious, and relatively recently that age has been increased for anybody not yet 70 and a half, has been increased to age 72. So that's the age at which you must begin to start taking distributions from most types of retirement plans. And again, a Roth IRA is not subject to RMDs for you as the account owner. And that's an important phrase, account owner. And the reason I say that is if you inherit an account, and we'll probably do a show on inherited accounts and different types of accounts and rules because that gets complicated in and of itself. But if you started a Roth IRA for yourself, for your own retirement, you as the account owner will never be required to take an RMD. However, if you inherit a Roth IRA, if Uncle Johnny leaves you a bunch of money, then you will actually be subject to some RMDs. And again, that will be for a different show. But it's something to keep in mind because if you don't need the money, what better way other than maybe some certain types of life insurance, and we'll probably do a separate show on different types of life insurance, but what better way to pass assets to your heirs income tax-free that you're not going to need, but you have them there just in case you did for your own retirement. So a Roth IRA can be a multi-purpose vehicle to accomplish some of those goals. Next is who qualifies for a Roth IRA? Well, first, you must have earned income or wages. So if you go to work and get a paycheck, boom, good to go so far. There's more. Wait, there's more. There's more. So if you are a W-2 and you go to work, you get a paycheck, or you're self-employed and you have wages, so far so good. You also must meet certain income limits for what's called a direct contribution. In essence, anybody can pretty much, although there was talk of changing this not too long ago, but it didn't happen, anybody can ultimately get money into a Roth IRA, and there's different ways to do that. But as far as making a what's called a direct contribution, which basically means you put the money in and you don't have to deal with any bullshit or jump through any hoops, boom, it just goes right in there. That's the easiest way for most people to get started and for most people to do it. However, you have to be within certain income limitations in order to do that, which we're going to get into here in a moment. Before I do that, I just want to make a quick mention that you also, if you have children, don't get too excited about this too quick, but if you have kids, you might consider having them open or you opening for them, depending on their age, a Roth IRA. Now, if you have really young children, like 2, 3, 4, 5, 6, it's going to be pretty hard to make an argument if you ever got audited to the IRS that your 3-year-old has a part-time job and has earned income. Like it's just not going to fly. However, if you have kids that are a little bit older, maybe teenagers, for example, that are working part-time, that do have earned income, that might be something to consider for them. So let's talk about these income limits as far as being able to make a direct contribution. And we're going to talk about the two most common filing statuses, which are single and married filing jointly. So for 2022, and for anyone that's listened to my emergency fund episode, that episode and the first one I did on health savings accounts were both actually recorded late in 2021. And so the figures that were used there are going to be slightly different if you're doing any sort of comparison, because at the time, those were the numbers that we had for 2021. These numbers I'm about to give you are for 2022. So they are adjusted slightly for inflation, and they are a little bit higher, something to keep in mind. So for 2022, your AGI, your adjusted gross income, if you are filing single and you make under $129,000 in 2022, you're good to go. No bullshit, no hoops to jump through. You can make a direct contribution to a Roth IRA. If you earn between $129 and $144 and you file single, you're in what's called the phase-out range, and there is a formula and a calculation to basically see how much your reduced direct contribution would be. In the interest of time, we're not going to get into that now. We may cover that a little bit on the advanced show, but we're not going to do that right now. Just know that it will be a reduced amount. And then anybody that earns over $144,000 and that's filing single, first of all, congratulations. That's a great place to be. And you, unfortunately, will not be able to make a direct contribution to a Roth IRA, but check out the advanced show. We'll tell you how to get money in there the other way. For those that are married filing jointly, the numbers on that for 2022, the first part of the threshold is $204,000. So if you earn less than $204,000 married filing jointly, you're good to go and you can make a direct contribution. If you're between $204,000 and $214,000, you're in the phase-out range. And anyone that earns above $214,000 that's married filing jointly, unfortunately, you're out of that phase-out range and you cannot make a direct contribution to a Roth IRA. Again, check out the advanced episode. So those are the income limits as far as being able to put money in. Next, we'll talk about contribution limits. How much money can we actually put into these things, assuming we're able to do so and we can make those direct contributions? And the answer is, if you're under age 50, you can put in up to $6,000 per year. And that was the same for 2021. So depending on when you're listening to this, if you're going to make a current year versus a prior year contribution, the income limits as far as qualifying to make a direct contribution have changed slightly, like I mentioned. But the contribution limits in terms of how much money you can actually put into a Roth IRA, those stayed the same. $6,000 under age 50. If you're 50 plus, you get an extra $1,000 age-based catch-up, so you can put in a total of $7,000 if you're age 50 plus into a Roth IRA. Next, we're going to talk a little bit about how is a Roth IRA different than a Roth 401k or other Roth employer-sponsored plan, which is basically a fancy way of saying a retirement plan at work. The most common one, there's going to be different ones out there. We're not going to cover them all. We're going to go over the most common one, which is probably going to be the Roth 401k plan. So you may have a 401k plan at work, and they might tell you you can put money in pre-tax or you can put money in Roth. And that's a whole conversation in and of itself, which, again, we'll table for another discussion. If you have the ability to put a Roth contribution into that 401k, that's essentially what we're going to be talking about for the next few minutes here with Roth 401k plans. So we'll do a little comparison and contrast. So with a Roth IRA, as we just talked about, there are income limitations for direct contributions. With a Roth 401k, on the other hand, there are no income limitations for contributions. You could make whatever, pick a number, $500,000 a year and still contribute to a Roth 401k at work if you have one. There's no bullshit or hoops to jump through. Income limits don't matter. You can make, as much money as you want to and still be able to make contributions to that plan. So that is a pretty big difference. The other thing is contribution limits themselves. So we just talked about those for the Roth IRA at $6,000 and $7,000 for under and over age 50 respectively. For a Roth 401k plan, those limits can be 3 to 4 times as much. So the limit for most employer-sponsored plans for what's considered an employee elective deferral, which is a fancy way of saying, hey, how much money do I want to put in out of my own personal paycheck? For a Roth 401k plan, you can put in for the year 2022 up to $20,500 per year for 2022. And if you're age 50 plus, you also have an age-based catch-up, but that age-based catch-up is up to $6,500. Under age 50, the Roth 401k is $20,500. Age 50 plus, the Roth 401k is a total of $27,000 when you put those two together. As you can see, the contribution limits are significantly higher on the Roth 401k plan. So that's another difference between the two. As far as investments go, you are going to be somewhat limited in the Roth 401k plan. The analogy I like to use is it's kind of like going to a restaurant. So let's say you like Mexican food and you go out to dinner at a Mexican restaurant and you get there and you look at the menu and you decide, you know what, I want Chinese. Well, more than likely tough shit unless they got a Chinese kitchen in the back of the Mexican restaurant, because you're going to have to order what's on the menu or you're going to have to leave the restaurant. So ordering off the menu is sort of similar to choosing investments from a menu of investments within your retirement plan at work. So eating at the restaurant and ordering off the menu, that's your retirement plan at work. That's your Roth 401k. The Roth IRA, if you step outside the doors to that restaurant, you can go anywhere you want. You want Italian, American, Chinese, Indian, whatever. You can go anywhere you want. And the world of investments essentially opens up to you. And so with a Roth IRA, you generally will have many, many more choices in terms of what you invest in. So that's the analogy that I often like to use. Does that mean that one's better than the other, or you should use one and not use the other, or anything like that? No, absolutely not. It's just something to be aware of. And again, there's always going to be exceptions to that, but generally that's how all that works. You will have more flexibility with a Roth IRA ultimately for the reasons that we've talked about, but a Roth 401k is also a great plan to consider. Ultimately, if you do have money in a Roth 401k, you can roll it over, and all else being equal, more than likely should, to a Roth IRA ultimately anyway. I mean, if you had one choice of an account type for retirement plan purposes that your retirement dollars end up in, the Roth IRA is kind of like the gold standard. That's where you want the money to be. And so just one other minor detail on the basic podcast to be aware of is that your Roth 401k at work, if you have one, carries its own 5-year clock versus the Roth IRA. So the Roth IRA and the Roth 401k each have their own 5-year clock for contribution purposes, and that is something to be aware of. If your plan is to accumulate a whole bunch of money in a Roth 401k and then basically retire, immediately roll it to a Roth IRA, and immediately start taking distributions, you might find yourself a little bit disappointed with how that works out for you because they carry their own 5-year clocks. So the sooner you can get a Roth IRA started and get that 5-year clock out of the way, the better, because once you do, you're never going to have to worry about it again. I could probably give a few examples in practice of how I've seen this not work so well for people, but in the interest of time, we're going to probably save conversations like that for some of the podcasts that we have multiple advisors on, and we can kind of have a little dialogue about that. So we'll save that one. You might be wondering, well, can I have both? Can I have a Roth IRA and a Roth 401k? And again, as long as you meet the qualifications that we talked about for the Roth IRA, yes, you can. So you absolutely can have both, and you may consider having both. In fact, you probably should. Everyone's situation is different, so it's kind of hard. I can't blanket tell everybody, like, yes, it's absolutely going to be correct for you. You can make that decision on your own, but I would say more likely than not, it's a pretty good idea for a whole host of different reasons. A couple considerations and things to keep in mind, and then we'll wrap up here, is that one thing you may want to think about is what we like to call tax rate equilibrium, or it's kind of a fancy way of saying balance. So some people can be quote unquote too good at saving money or investing money in pre-tax plans. And we talked a little while ago about required minimum distributions, or RMDs, on a lot of other types of plans out there. If you're somebody that has most or all of your retirement money in these pre-tax plans, and ultimately that drives you to have to take out larger required minimum distributions at age 72, you might find yourself disappointed when you have accidentally permanently pushed yourself into what could be a much higher tax bracket that essentially you can't get out of because you have to take that RMD every year. Presumably that's in addition to other income sources, maybe Social Security retirement benefits, perhaps a pension, other income streams. So just something to keep in mind as far as finding that balance of having some buckets of tax-free assets available that will generate tax-free income, as well as some of the other accounts that might be pre-tax and end up generating income at ordinary income tax rates in retirement. Now versus the future, as far as where tax rates might be headed, everybody has an opinion. Hopefully you have one. Tax rates, if you look at them now, are near historic lows. And so more than likely, for a whole host of different reasons, they're probably going to be going up. If you feel like tax rates are going to go up, if you feel like your income is going to grow over time, depending on the stage that you're at with your career or your business, and just tax rates in general, unless you're planning on retiring poor and living on cat food, and if you are, good luck to you. Hopefully the show could somehow help you out, but it might be too late for you. But anyway, unless you're planning on doing that, you might want to consider getting some money into these tax-free zones as quickly as you can. And so that pretty much, I think, wraps up the basics of Roth IRAs today. We're coming into about 30 minutes or so on the podcast, so we're going to go ahead and wrap it up here. Hopefully you enjoyed it. Again, thanks for taking the time to be here with the Cash Flow King today on Real Talk Personal Finance. If you found this valuable, feel free to share it with somebody that you know. Always would appreciate a 5-star review if you feel as though we've earned it. If not, keep listening, and I promise you we'll earn it from you at some point, as long as you're not offended by the vulgarity. But if you are, you shouldn't have clicked on the fucking podcast with the big E on it anyway, right? All right, thank you again for being here. We're going to cut the episode. We will see you in the next episode.
Check the mic and make sure it sound right, boys.